I guess there was a bomb scare right down here last night. I'm staying right
Oh,
across,
really?
right around the corner, yeah.
I did not know that. You know what? I would imagine they happen
Got it roped off.
multiple times during the day around here.
I had to go to Walgreens to get my razor. I forgot my razor. I had like 3 days of growth, and so I couldn't get in one side. I had to go around the other.
Oh.
I'm glad I found a razor. I'm a little scuffy.
Yeah. Been there, done that, forgot those on vacations.
Actually are creating lens flare. Yeah, it's doing lens flare. About 10 seconds.
Good morning, Facebook. I'm Jill Malandrino with the Voice of America, and this is NASDAQ's Facebook Live. Joining me today is Greg Womack of Womack Investment Advisors. Greg, thank you for being here, and welcome back to New York and joining me here at the NASDAQ market site. In February, we had quite that run since President Trump got into the White House, and it seems to be it's continuing a bit here.
Yes, it is, and thank you, Jill. It's great to be back. Yeah, the markets since February we talked are up about 4.5%, but about 6.5% for the year.
Right.
So it's not a bad start to the year, especially with all the excitement coming into the year from the election, but then a little letdown due to some of the healthcare laws not passing and are being voted on. So those are things right now that the market's kind of a little weak.
It's been impressive how the market has held up, though. Okay, no healthcare, tax reform is sort of in balance, immigration reform. There's a lot of uncertainty that's out there, and classically we've been trained that markets don't like uncertainty and you expect more volatility, but volatility is at depressed levels, and the market's actually held up quite well. Does that change your way of thinking about how the market reacts after all the years of training that we've had to look at uncertainty as a bad thing?
Well, one thing we know that is the markets typically don't do what the masses think.
Of course.
So, but we are seeing much more optimism in the general business community. CEO optimism is way up at record levels, and you see a lot of optimism of what can happen. And you're seeing a lot of things that President Trump is doing without Congress, and he's been on a deregulation warpath, if you will, to really create more of a business environment, take away some of the roadblocks in the regulation area. So that's been a very big, I think, stimulus just from a mindset of the market.
Right. Well, I also think it's interesting, too, the New York Times had a great piece on Sunday this weekend that Trump is meeting with a lot of business leaders. I think it was over 200 meetings that he's had since he got into office, and he is listening and reversing positions on some things like NAFTA, for example, or his attitude towards Chinese currency and our relationship with Mexico and with Canada. So perhaps these are lessons being learned, and every president goes through that in their first 100 days. So if he continues on that path, not only is he more business friendly and wants to deregulate, from a larger macro perspective, that could be a good thing and lend support to the market. Would you agree with that?
Yes, I would, Jill. I would agree. And I also agree that we do need to see some changes in some of these laws passed, that his agenda, because without that pro-business agenda finally passing, it's all just kind of hoping and waiting. So I think we're close.
Right.
And I think they'll be very bullish. If you get any of the, whether it's the health care, the tax plan, or even the infrastructure plan, any of those would be very bullish for the markets and the economy.
Well, let's talk about developing an investment strategy and what you do over at Womack Advisor. There's a couple things you want to ask yourself before you do invest in terms of what your goals are. What's your process there as it relates to the environment right now?
Well, a successful investment strategy is one that is well thought out and planned. Occasionally, someone can get lucky and make a great investment, but it's really developing a foundation, and that is, what am I investing for? So as an investor, you need to ask yourself, okay, what is my goal? Is it retirement? Is it college savings? Or is it just to make a pile of money? And then also you need to know what is your time frame. Because you don't want to put money in the market you need in a year or so. So, because it's too risky, and the markets drop, you need your money, you got to sell at a loss. So, we encourage clients to put away their safety money, but focus on the money. So, what is your time horizon? That really helps define your objective, but then more importantly, how much risk are you willing to take?
Right.
So, if the markets get choppy and get very ugly, what is your exit? What is your limit for losses? So, that's the foundation. Once you determine that, then you're able to say, okay, here's where I need to be looking for investments to fit my objectives, my goal, my time horizon. And then that's where you begin to start crafting the individual pieces of the pie.
Right. So is it like more of a question of passive versus tactical management in this type of market where some retail investors have been thinking to themselves, okay, the market's up 6.5% on the year already. Did I miss any of that? What kind of approach do you take at this point? Would you be more passive, or are there tactical strategies you can employ?
So passive investment is where you just kind of buy and hold, what I call buy and hope. And with market valuations where they're at today, Jill, I mean, they're approaching record levels. So at some point, we could be in the late stages of a bull market, the late stages.
Right.
And so about every 7 or 8 years, you have, the markets do drop substantially to make it more affordable and bring valuations in line. So from this level, tactical, what does that mean? That means I'm going to invest in a strategy that will move according to the markets and the trends. So if there's, the momentum is where you want to go with the market, but if the momentum changes, you want to pull back and protect. So a tactical strategy adjusts to the market and is very rules-based versus emotion-based.
Right.
And most investors, get in trouble when it comes to investing because of their emotions.
Well, I think a lot of investors too, they're so worried about timing the market that they forget about their risk and reward parameters because, we'll sell off, let's say 200 points in a day, and we haven't seen that, or we've seen it very rarely over the past 5 to 6 months. And then the question is, okay, do you reverse your strategy there? Is there a time frame, or is there a certain thing you look at in terms of momentum that makes you tactically switch around your asset allocation?
But what we do is we've developed a tactical model. So
Right.
most shops or even mutual funds do have tactical strategies where they will adjust and sort of kind of rebalance basically, but it's also looking at momentum, what is the top, what's the up and coming leadership of the market, what sectors.
Right.
So it focuses on the top sectors of the market in top areas and reduces the weaker ones. But if the market weakness, in general, has weakness, then it pulls back and raises more cash
Got it.
in most areas, and it becomes more defensive or neutral. And right now, a lot of our models, based on the market, I mean, even though the NASDAQ has made, new highs, the NASDAQ is really, probably 10 or so companies that are moving the market.
Right.
So there has been some weakness in the market. So for example, a lot of our tactical models have pulled back where we're about 60% cash and just waiting until our strength indicators of the market improve. And when that happens, we go back in 100%.
Right. Now, how about bonds and using them for diversification and safety, because they have not been on the upside of
Right.
the momentum scale for sure.
Well, historically, bonds have been kind of, the safe haven, or if let's put it this way, a lot of people would do their asset allocation based on their age. You take 100 minus your age.
Right.
The difference is how much you need in bonds or stocks. So if you're 60 years old and minus 100, that's 40. So you'd have 40% in equities, 60% in bonds. So if you use that ratio, the younger you are, the more you have in equities. The older you are, the more you have in bonds. But the problem with that, Jill, is interest rates have been so low for so long, is that there's a huge potential bubble in the bond market. So if someone who is older says, I want to get more conservative, put more in bonds, I mean, they could be setting themselves up for a worse fall than stocks eventually. Because if interest rates rise, the value of those bonds will go down, because if you're holding a 2% note down here, or 3, and rates are now 5, if you want to sell that 2% note, you can't sell it for par. It's got to be sold at a discount. So bonds can be, and with the credit markets today, and we're seeing huge amounts of consumer debt, student debt, car loans, these debt levels are getting very high. So we've created this ultra low investment environment in the credit markets, we've created this huge debt level. And some of that's been subprime, and especially in the car area.
Yes, yes, that has been a big topic of conversation. But do you think that there has been the run in equities because people who rely on either bonds or bank interest rates for income have been turning to utilities, they've been turning to REITs, they've been turning to, let's say, even energy companies that are paying those higher dividend and yield paying investments? You have to. There's no way you can rely on an income strategy using bonds or the banks.
I agree. Yeah, interest rates have forced more monies into the market
Right.
for that higher yield and better opportunity.
How about non-correlated assets like gold, for example, as a way to perhaps generate some income or to hedge yourself against equities?
Yeah, it's a great point. We use gold. Naturally, gold and silver have been in a downturn over the last 5 or 6 years, but now are starting to bottom out and come up. So the gold market's very interesting. You know, a lot of people don't like gold because, you know, it doesn't pay dividend, just sits there, that type of thing. But world governments around are purchasing gold for their reserves, and so that's increasing. And we're starting to see some of where the countries, particularly the emerging countries, are going around the dollar and trading with some of their partners outside of the dollar, say such as gold for oil.
Right.
And if you see that trend continue, what you'll see is that gold become a bigger player in the world trade market, in the currency baskets. So the gold market is interesting. It has provided diversification for a portfolio in the past. So for example, adding a 10% gold holding in precious metals in a traditional portfolio has helped reduce risk over the longer term. And especially with now gold, you know, coming off of its 5-year lows, I think this could be a very good opportunity to be adding some gold to your portfolio.
Well, to wrap it up, what's the typical tactical portfolio at Womack right now, considering that you're less exposed to bonds, you might have more equity exposure based on momentum?
So right now, you know, tactical is our core. So you need a good tactical. Basically, that's saying we're not going to buy and hold. We're going to adjust to the trends of the market. So if the market wants to go down and go through a bear market, we're going to prepare for that in the tactical model. So that's your core. And then outside that core, you may have things such as a non-traded real estate investment trust that pays very good cash flow, triple net leases, for example. And so those will pay, you know, 5 to 7%, you know, on average. And then you may have some preferred stocks that aren't as volatile as the underlying stock and provide high income. Also perhaps some subordinated notes or floating rate notes. These are notes that are issued by mid-level stock companies that are paying higher interest rates. And if the interest rates go up, these notes will float with that. So it helps you, protects you against some of that interest rate risk that we talked about. So looking at a traditional, our average model, you may see, well, here's 70% that's tactical, and the other 30% spread among some of the non-correlated assets such as gold, subordinated notes, floating rate notes, and then also maybe perhaps some non-traded REITs. So that, gives you a good diversification.
It certainly does. Well, thank you so much for joining us at the NASDAQ.
You're welcome.
I hope to see you soon over the summer.
Thank you, Jill.
And thank you, Facebook, for joining me. As always, I'm Jill Malandrino, Global Markets Reporter at NASDAQ.